In this video, we're going to walk through basic note receivable journal entries. We're going to show the impact of each transaction on the balance sheet and prepare journal entries as well. We're told that on April 1st, 2021 or 2020, Vandelay loans $10,000 to a customer opening a new store. So the note, again, we're lending our customer money. The note bears interest at 12% annually and becomes due on March 31st, 2021, so a year from now. So let's go ahead and prepare the journal entries at the time the note is entered into, as well as our year-end adjusting journal entries and the entries when we collect the note. So when we lend the customer money and they sign a note, we have an asset, notes receivable, for $10,000. And of course, we've given the customer $10,000 in cash, so we credit cash for $10,000. On December 31st, 2020, we aren't going to actually collect any interest from our customer, but they owe us interest. Our interest revenue is going to be $1,200 per year. That would be the $10,000 times 12%. And on a monthly basis, that works out to be $100 per month. We've earned 9 months worth of interest, April to December. And so we need to record interest revenue and interest receivable. And unless we're told otherwise, interest rates that you see, the 12% or whatever interest rate it is, it's an annual interest rate. They're always annual interest rates unless you're told otherwise. So 9 months of interest at $100 per month, we've earned $900 in interest revenue. That, of course, will increase net income, which will increase stockholders' equity. So we credit interest revenue for $900. Our customer doesn't have to give us the $900 today, but they owe us an additional $900. So we will record a debit to interest receivable, an asset. Then on March 31st, 2021, we're going to receive payment for both principal and interest. We're going to do this in two different or separate journal entries. In this first journal entry, we're going to record the receipt of the $1,200 in interest on the note. So we're going to get $1,200 in cash. And recall, we had an interest receivable, an asset on our books for $900. Once they pay us, they no longer owe us that $900. So we want to take that receivable off our books with a credit to interest receivable of $900. The remaining $300 is the interest we've earned for the 3 months of 2021, January, February, and March. Now that takes care of the interest portion of the payment, but they're also going to repay the principal of the note. We're going to get $10,000 in cash, so we credit cash for $10,000. And we no longer have a notes receivable, so we credit notes receivable for $10,000.